Hello, thank you very much for joining me for this biweekly market update for October 14th, 2018. My name is Brad Reinard. I'm the Chief Investment Officer for Monthly Cash Thru Options. If you'd like more information about our firm, please go to our website at monthlycashthruoptions.com. And on the bottom right, I just show 4 strategies: small cap momentum, contrarian fund, sector rotation, and directional alpha. And you can see what our returns are as of the end of September 2018. Okay, the market had a pretty nasty pullback. So we'll look at a lot of charts. We'll talk about the economic data. We'll talk about some of the breadth data and other indicators that we watched that help us predict if we're going to have a pullback. And then I'll just give you my opinions of, I think, where this market is going. Sell-offs happen. They're no fun when they hit. In general, they are healthy when they do happen. The economy is strong. Job growth, fiscal stimulus, which is the tax cut, earnings growth, consumer spending. So the economy is strong. Stocks went up for 2 years after the Trump win, basically in anticipation of deregulation, infrastructure spending, and a magical incremental $8 of earnings that would just show up from the corporate tax cut. And the tax cuts did go through, and an incremental of $8 of earnings went to S&P 500 earnings. That only happens every 20 to 30 years where we have some type of tax cut like that. Stocks currently are fairly priced at 16 times forward earnings of the S&P 500 stocks. And we're showing right now of $173 of forward S&P 500 earnings. A lot of technical damage was done to stocks in the short term from this pullback. And the SPX is probably not going any higher than 28.73. That's probably going to be the resistance level through December or January now since this pullback. Concerns that triggered the sell-off. The yield on the 10-year Treasury broke up through a major resistance level, pointing to higher inflation. Rising input costs for companies from the trade war are a concern now, and that could slow earnings growth. The Fed is raising short-term interest rates, and some people believe they're raising them too fast, which will slow economic growth. Concerns that the fiscal stimulus will lose momentum by mid-2019. That's the corporate tax cut. And corporate debt markets were sending signals of stress over the last 9 months. The flattening yield curve of the U.S. Treasuries, that's been happening for a while. We'll show a chart on that. Small caps have been rolling over for about a month. And then finally, the SPX broke below 28.73. And that was the big one. And we'll show a chart on that. And that's what actually triggered the sell-off. So here's the culprit, the TNX. This is the 10-year note. And the interest rate broke above 3.11. And that is what caused a panic in the market. HYG, here's the high yield bonds. And we can see that they've been kind of bottoming out around 84.8. And this just tells me that the corporate debt markets are demonstrating some stress. Here is the yield curve. It's the difference between the rate on the 10-year note less the rate on the 2-year note of treasuries. This is U.S. Treasuries. There's only a difference between 30 basis points between the 10-year note and the 2-year note. That means that the yield curve is flattening. And when the yield curve flattens, 1, banks can't make money. It's not good for them. And then 2, sometimes it starts sending a message that the U.S. economy could go into a recession within the next 12 months to 15 months. Do I see a recession in the next 12 months? No, I don't. But the yield curve is sending some negative signals. Here's the RUT. The Russell 2000 represents 2,000 small cap stocks. And this was rolling over as of early September. But it really wasn't sending any negative, horrible messages until finally it broke below this breakout right here. And that was at the end of September. Here's the small caps. This is the cumulative advanced decline line. Basically, it's on a daily basis. We look at and this particular one is the S&P 600 index. So it's 600 stocks. And we look at the number of stocks that advanced that day minus the number of stocks that declined that day. You get a number, and then you take that number and you just keep on adding that number up every day from day to day to day, and you get a cumulative advanced decline line. This is a nice indicator to watch because it gives a reasonable predictive view of what the market's going to do. And we can see that the small caps were starting to roll over as early as early September. But again, this is tough because you're looking for lower lows, and it really didn't start causing any major concerns until finally here, which was really the very first week of October. This is the NASDAQ percent of stocks above the 50-day moving average. And this one has been weak ever since, like right here. I was actually looking at this and I was concerned. I'm like, wow, this is interesting. The stock market's still grinding higher, but of the 2,500 stocks in this index, it's not that strong. I mean, it really should have been more like closer to 60 and staying in the 60-65% range, and it was getting weaker and weaker. So that was definitely giving me a signal that things are slowly deteriorating. Okay, and this is the big one. For the S&P 500 index, we can see that 2873 was the January high. That's called a major breakout level. This was resistance. The stock broke up through, and it stayed above here for about 6 weeks. And that sent the message to me that, okay, there's a high probability we're staying above 2873 now. And we're going to be in the new trading range of 2873 up to 3000. But all the bots, these are the algorithmic bots that do, probably handle 40% of the volume on the entire market, including institutions, and anyone in the business was watching this level. And when it broke through, that was it. And that day, we were down 4% on the SPX on tremendously high volume. So we can watch these levels, but once they break, you don't have a lot of time to react. Luckily for our portfolios, we were down from, we're down in the 15-20% allocation range already before this happened. Okay, so what we monitor to help predict sell-offs? Well, we look at breadth, advanced decline lines, like I just showed you, number of stocks above the 50-day line, that's also classified as breadth. Also, how stocks in our portfolios are behaving and if they are triggering exits. I'll talk more about this in a minute because this is very important for us. We're watching hundreds of stocks a day and we have 4 portfolios that trade a lot of stocks. So once our stocks start triggering exits, then we know something's going on. And we started seeing that a week prior before the pullback. We monitor the health of the major indexes. Here's the SPX. This is the S&P 500 index, the mid caps, the small caps, the NASDAQ composite. This one has 2,500 stocks in it, and this is the NYSE composite. And we're watching support levels, as I showed. For the SPX, we cared about the 2873 breakout level. Care about corporate debt markets because this will create problems for us, and that was kind of showing stress. So usually we're able to see that something is brewing. However, it is pretty much impossible to know exactly when it's going to happen, how deep it's going to be, and the duration. Back to what we were monitoring to help predict sell-offs. And I mentioned that we're watching the stocks in our own portfolios and how they're behaving and if they're triggering exits. Well, this is one of the more reliable early indicators for us because of the portfolios that we have. For example, in the MCTO Small Cap Momentum Fund, the exit triggers were starting to happen 1 week prior to the sell-off. And within 5 days, we went from 75% invested down to 15% invested. Now, we're just following rules, and we have to do what the market is doing, and we have to react accordingly, and we have to follow our exit rules. And before we knew it, we're down to 15% invested, and the market was forcing us to do that. So we knew that something was coming. It's just, again, you just don't know. You just don't know when it's going to happen and how deep it's going to be and how violent it's going to be. And we saw the same thing in our other portfolios too, the directional alpha, contrarian fund, and the sector rotation. So we got down to very low levels of allocation within 5-6 days. Let's look at lots of charts and then I'll give you a summary of my thoughts of kind of where we're going. So here's the industrials, the Dow. We can see that this is the January high of 26,623. We broke above it, we failed, and then it was just ugly. We're way back down here at the 200-day line. Now that's good that it's finding support at the 200-day line. Good chance that now we'll stay above the 200-day line and we're going to trade in this range. And next resistance level is going to be 25,794 right here, or the 50-day line. This is the 50-day line, this blue line. So it's going to take a while to get up to the blue line, and then we'll see how long it stays under the 50-day line until it finally breaks up through. SPX, we already showed this one. 2873 was the January high. We stayed above it for about 6 weeks. Once we broke below 2873, that triggered everyone to start selling, including us for the little bit that we had left. We were already pretty much down to maybe 20% allocated when this day hit here. This is the SPY. This is the ETF that tracks the S&P 500 index. I have these indicators down here. I'm just seeing if anything looks interesting. Well, what this tells me for the commodity channel index, the CCI, anything in negative 200 or less tells me that it's very oversold. And so this is very oversold. So we usually get a bounce, and this is usually when we're done going lower. But we need to stabilize first, and that's going to take many days to stabilize. So hopefully this is the bottom. NASDAQ Composite, this one has 2,500 stocks in it. It looks like it's finding support around the 200-day line. We are below it right now, but overall that's good news. And CCI is around minus 200, so we're very oversold. We'll bounce. We'll get over the 200. We'll probably get over the 150-day line. We'll probably pretty quickly get over this high, 76.42, and then we'll start trading right in this range for a while. And it could be for a long time. We could stay under 79.33 and stay in this range all the way through December or even January. Mid caps and small caps, these usually overshoot quite a bit. They're going to have the most damage because they're the ones that get overbought the most. Mid caps, this was the January high, 363. We broke over it, stayed over it for about a month and a half, failed, and then just really overshot. So we're down here at the lows of the February-March lows. Doesn't surprise me at all. We'll see how long now it takes to grind back up to get over the 200-day line. This will not be classified as safe or healthy until it gets back over the 200-day line. Volatility, we can see it spiked up. What I'm taking from this is that in the January timeframe, the volatility really spiked high up to the 50 range. This one only went up to about 30. And now we're kind of in the low 20s. 21 actually. So that tells me that this might be short-lived. And again, the economy is pretty strong, very strong. So I think this probably will be short-lived. This is the dollar index, UUP, and things look good. The dollar is strong. We just don't want the dollar to be too strong, but this looks good. Let's look at Europe, EUFN. This represents the financials over in Europe. We can see that most of these all look the same. They've been in bad shape, but most of this was from the Trump trade war. So I really wasn't reading too much into it. Usually, if this trade war were not going on and I saw charts looking like this, then I would have been much more careful because anything that's happening over in Europe, sooner or later will wash ashore into the US markets. But again, the trade war was causing most of this, at least I believe. So the EUFN, here's the United Kingdom, looks the same. Here's Japan, looks the same. At least it's finding support at this major support level. China looks okay. We just don't want this to be crashing. China's economy is slowing, but again, mostly trade war. And China is the main target by Trump. So this doesn't surprise me at all that the stock market's been down for China. Okay, let's look at the ETFs, at least some of them. I usually look at about 30 ETFs, and actually for sector rotation, we have 60 ETFs that we follow. And then we'll we'll buy the strongest stocks in the strongest sectors. But I just look at a few here for kind of the big picture indication of what the economy is doing and where the money is flowing into. So financials are getting pretty beat up. So money is definitely not flowing into the financials right now, and the yield curve is flattening, as I showed on one of the charts. That's not healthy for the banks. Here's industrials. These all look the same. I mean, if it finds support at the 200-day line, that's pretty darn good. If it overshot below the 200, it is what it is, and we'll have to wait for these to stabilize and then see where they go. Banks just got clobbered. We're not making any money in financials or banks right now. Consumer discretionary, and this one's finding support at the 200-day line and at this high. So this actually looks pretty good. So not bad for consumer discretionary. My guess is that's going to bounce back pretty fast. And I wouldn't be surprised if we start moving for our sector rotation strategy, we'll probably move into some consumer discretionary stocks if we see some that we like. Transportation beat up pretty badly. We'll have to see where it stabilizes and where it bounces. Semiconductors got pretty beat up, not good. Technology looks pretty good broadly. This is good. Find support at the 200, finding support here. So tech remaining to be strong or showing some strength is actually good news. Okay, S&P 500, the percent of stocks above the 200-day moving average. So this is 500 stocks in this index, and the percent of stocks above the 200-day line. This is down to 45% are above the 200-day line. And it doesn't surprise me. It was a really nasty sell-off. So we'll see where this goes once it stabilizes. NASDAQ Composite, advanced decline. This is cumulative advanced decline line. Very beat up. We just have to give it a little bit of time to see where it goes. Just tells me that we've had a tremendous amount of technical damage. NASDAQ Composite percent of stocks above the 50-day line. Only 17% of the stocks are above the 50-day line. That is really oversold. So this will bounce. S&P 1500, this has small, mids, and large cap stocks. You can see it just rolled over. And it didn't give us that much of an early indicator. Actually, again, it starts flattening out, it starts rolling over, and really not until the beginning of October did it really start giving us some indication that we might have a sell-off coming. Okay, let's look at the economic data. Initial unemployment claims looks great. It's been below 300K new claims continuously for like 185 continuous weeks. It's just crazy. So this is almost unprecedented. So that looks good. Non-defense capital goods, less aircraft, less defense. This is what equipment that companies are buying for their companies. And we can see that this looks strong. It's growing 10% year over year. Core retail sales, that drives about 2/3 of the U.S. economy. This looks strong. Real GDP looks good. We're about 3% or greater. ISM index, this represents manufacturing across the entire United States. This has been strong for a long time. It looks good. Anything over 50 means that we're expanding. So we've been expanding. Construction spending, this one's been kind of rolling over. And this represents like 10%, well, about 8% of the overall U.S. economy. So it is important, but it's still growing. Year over year, construction spending is still growing by 5%. Earnings. This right here is the price of the blue is the S&P 500 index, and then the black is forward 4-quarter estimated earnings. I'm sorry, the black forward 4-quarter earnings for the S&P 500 companies. So you're adding up dollars per share that each of the 500 companies in this index are going to generate, and you add it all up. And we're at about $173 worth of earnings. Forward 4-quarter. And this is huge. I mean, this has been very, very strong earnings growth. Now, the corporate tax cut added about $8 to this. Right here, it just kind of magically showed up, but it's still climbing. So companies are doing really, really well in knowing how to grow earnings in all kinds of market environments, especially in the last 6 years when the economy was pretty bad. So they learned how to be lean and mean and how to generate earnings. So this is really strong. That looks great. Consumer sentiment looks really good, still climbing. The happier people are, the more they'll spend. Core inflation is climbing. Now, this is expected. The Fed wanted about 2% inflation. We have about 2% inflation now, and they wanted the economy to run a little hot. So overall, that's good. You're going to have inflation when the economy is doing well. Vehicle sales, cars and trucks were around 17 million, and it's climbing. Now, it is flattening out, but this is not sustainable. You can't really get much higher than this. But it's been very strong. So if people are buying cars and trucks, that means that they are feeling confident with their jobs and their income. Personal income and spending, this is very important. The more income people have, so money coming into their pockets, then allows them to spend. So the orange is growing about 5% year over year, the income coming into people's pockets. And then their spending has also been growing, and that drives 2/3 of the U.S. economy. So that looks good. And this is personal spending. This is actually this blue line here, and this is another representation of it. So this is month over month. And we can see personal spending of the consumer has been growing continuously by 0.4, 0.3%, sometimes as high as 0.8% month over month. Okay, almost done here. Unemployment rate has been dropping ever since when things turned around in 2009. We're down to sub 4%, so we're pretty much at full employment. Hourly earnings for employees is climbing, and this is very good. It means they're putting more money in their pockets, so they're spending more. But that does drive inflation, and that will drive the Fed to raise rates, and that's just part of a strong economy. Non-farm payroll. So this is the jobs report that comes out the first Friday of each month. And this has been super strong, plus 150,000 jobs every month for years. So this economy has been growing well. Let's see, this is another representation of this chart. It just goes back all the way to 2002, and this is non-farm payroll changes. So you can see it's been very consistent and steady, pretty much 150,000 jobs or greater on a monthly basis. Okay, wrapping things up. To summarize, the economy is strong, so job growth, income growth, manufacturing, fiscal stimulus, that's the tax cut, corporate earnings growth, consumer spending. I showed all those charts. They look good. Stocks are fairly priced. They're actually not even expensive. Right now they're trading at 16 times forward S&P 500 earnings of $173. The SPX 2873, that's why I show the chart here, 2873 is probably going to be the high resistance. It's going to hold as resistance through December or January. This is a lot of technical damage. Most likely this is going to hold as resistance through, again, December or January, and then we'll see what happens. Usually the strongest months are through April. If we break up through 2873 in January or even December and start climbing into April, I wouldn't be surprised because those are very strong months and the economy is still strong. But we got a lot of damage here and it's going to take a while to get back up to these highs. The SPX could break out to a new high in January and grind up to 3,000 and even possibly 3,100 through April, but we'll see. Again, a lot of technical damage. There's a good chance we'll be staying under 2873, and the SPX is going to trade range bound here. Okay, yep, SPX will probably trade range bound between 2,800 or as low as the 200-day line of 2760 up to 2873 through December or January. Fed will continue to tighten because they are doing their job. And the long interest rates, the 10 and 30-year rates on the treasuries, they will continue to move higher, and this is expected for a growing economy. Okay, that wraps up the biweekly market update. And for more information from our company, please go to monthlycastroptions.com. We have a toll-free number here. We have 30-day free trials for these products if you're interested. And if you want to sign up for this free biweekly market update video, then please go to our website and you can sign up. Thank you very much for your time.